Well, howdy there, folks, and welcome into the first video ever on a brand new YouTube channel. And yeah, I don't even know how you found this video. Like, how did you find this video? Because I'm not shouting this channel as of right now on any of my other social medias and whatnot. So if you found this, good for you. Okay. But in this channel, what I'm going to focus on is reacting to interesting videos that I want to bring to everybody's attention and give my 2 cents on. And you know, in the finance space, obviously, and one in which I actually just got to see a bit ago that I think is very, very interesting that I want to react to is this one. As long as the Fed raises interest rates, tech valuations must go down. So I thought this was a good one to bring to everybody's attention and kind of give my 2 cents on. So appreciate you joining me. Much love as always. Make sure you're subscribed.
I think it's driving tech right now. I think in May you said it was giving you June 2000 vibes, and that was sort of before an even bigger drop. How are you feeling right now?
Well, we're still going through 2000. This is not surprising. This is exactly what happened in 2000. The Federal Reserve raised interest rates 6 times from 1999 to 2000, and tech stocks collapsed.
6 times the Federal Reserve raised rates from 99 to 2000. So that's an important number to keep in mind. The Fed's much more aggressive right now, or at least they seem to be, with like 75 basis points, 100 basis points talking about for the next one. So I don't know if we're going to do as many rate hikes as maybe they had during that time period, but it could be pretty close. It could, but it's much more substantial numbers, right?
Valuation. This wasn't completely predictable. As you know, on November 18th, I accurately predicted this was the top of the market. And we're just going through the process of weaning out the people who didn't believe. The disbelievers are just going to have to go away. We haven't quite hit June 2000 when all the disbelievers in 2000 went away, but that's going to happen any day. We are in a new world order, and as long as the Federal Reserve is raising interest rates, tech valuations have to go down. This is an inevitable law.
Did he say new world order? Oh boy, so there's going to be some folks that are triggered by that.
It's basic, finance 101. I just actually am astounded that 99% of people don't seem to understand.
When you allude to June 2000, Keith, just to be clear to our audience, that was sort of a bear market run, right, before an even steeper drop. When are you going to know that sort of we are there and there might be some opportunity, or rather we're at a bottom and there's opportunity to get back in?
Well, if you studied March, so what happened when the internet bubble, in quotes, collapsed, it collapsed in 2 phases. First in March of 2000, late March 2000, and then permanently really collapsed in June. And that's when, sort of all hell broke loose and people realized the world had changed permanently. But it took 3 years at a minimum to escape from that change. And I don't think it's going to be a very fast recovery. As long as inflation is going up, interest rates are going up as well in the United States, unless we go on an austerity kick, which would not necessarily be a bad idea. Cutting government spending might be a better idea, but that doesn't seem to be a lot of political will to do that. So interest rates are the only variable. And if interest rates go up, tech valuations are going to go down. Tech valuations must go down because the discounted cash flows must be divided by a different number. And as the number you divide by goes up, the valuation inevitably goes down. Most tech companies do not mint money in the short term. They intentionally try to mint money 5, 10, 15, 20 years in the future. And when you divide by a different discount rate, those companies are just going to be worth 10, 20, maybe 25% of what they used to be worth.
Yeah. Okay, so first off there, a big statement, worth 10, 20, 25% of what they once were worth, right? So you got $100 stock here, and basically he's saying it's worth $10, it's worth $20, maybe $25 and things like that. And that's actually what we have seen with valuations. And basically the more they raise interest rates, this gentleman basically is pointing out that the lower those stocks are going to continue to go and the lower they're going to be worth, right? And so now one thing I will say is a little different in this market versus the market of 2000 was, the market of 2000 was driven by a lot of speculation in companies that hadn't really proven anything as business models yet, right? And we're in a very different market. Nowadays, the NASDAQ in the stock market in general is run by well-established companies that are some of the biggest in the world that have incredible top lines and incredible bottom lines in terms of their net income. So it's a very different tech space nowadays than it was back then. Like everything people were betting on would end up happening back then is all actually happen nowadays, right? So I think that it is important to remember it's not an identical situation by any stretch of the imagination, but the way it's kind of playing out is similar, at least from interest rates going up, these stocks got to go down, right?
Keith, I think so many people forget the dot-com bust wasn't a moment and it's like, oh boy, it was down and now it's up from here, it was a whole mood. It was like a period where people soured on tech and its prospects. There were questions on whether the internet was overhyped. But I really want to talk to you about e-commerce. How do you see this inflation that we're experiencing right now affecting the small businesses that you're trying to roll up and operate better with Open Store, particularly when it comes to wallet sizes and customer acquisition?
Well, if you look at the actual data, the consumer behavior hasn't really shifted yet. You see some weakness in some e-commerce companies like Wayfair and a little bit of Etsy, but fundamentally, this is a macro correction. Like if you look at Shop's market cap, which is roughly 25% of what it was a year ago, it's not because Shopify is missing its numbers per se. It's because you're dividing by a different interest rate and creating a totally different discounted cash flow analysis. So we haven't yet seen what happens if consumers really stop spending. So what you might see then is, and this did happen in 2000, you had the interest rate corrections first, then you had companies missing their metrics, missing their earnings. The combination of those is pretty catastrophic. Then you're talking about a 10% market cap compared to what you were at, a year ago. And that may happen because
that's rough. Oh, that's rough. Oh my gosh. And I mean, shoot, we're getting there with some of these stocks now. I mean, some of these stocks are literally down, between 70%, 90% from where they were literally, in 2021. The crazy part of that is, if you look at Amazon stock in the tech bubble, that stock fell over 90% peak to trough, over 90%. So it's not a real possibility that, many other stocks end up falling 90% peak to trough. Like I said, different situation nowadays in terms of where a lot of these companies are positioned, where they're at in the market. But my gosh, man, it's just crazy to think that, and we've seen it play out like that before. So
some evidence on the horizon that consumers may be a little bit nervous, but there's no clear, unequivocal evidence that consumers are pulling back their spend yet.
Woo. Okay. So yeah, the big statements by that gentleman there, I can't disagree with him, at least as far as interest rates. The more they go up, the lower valuations have to come for stocks. That's just the way it goes, right? And, imagine if tomorrow the Fed funds rate was like 10% and you could generate, a ton of money by just putting your money in a savings account at the bank or something like that. That changes, the dynamic for the stock market. And then more people want to put money in savings accounts versus put money in the stock market then at that point in time, right? The big question is, how long can the economy withstand higher interest rates? I think that's the biggest question that remains to be seen, is how long can the economy go with interest rates that, let's just say, are in a higher state, because we haven't seen that in recent times. It's like in recent times, the only thing we've seen in recent times is insanely low interest rates, right? And we know stocks can perform well in that environment, but what happens if we remain high for a while, right? And so, I think all this just takes time to play out. It's a game that just takes, everybody wants it to be fixed tomorrow, and it's not fixed tomorrow. There's a game that takes a while. But the good news is, if you're a buyer of these assets, right, you're getting one of the best opportunities you've gotten in modern times, right? I mean, if you were buying stocks, while the whole tech bubble bursted, my gosh, you got some great deals. I mean, look what Apple stock was back then. Look what Amazon stock was back then. And those were business models that you could, in my opinion, bet on in 2001, 2002, 2003, when the whole tech bubble was, like those were like, in my opinion, kind of like obvious companies that they were the future. Like they had great prospects, they had good growth. You looked at the financials, it was there, in 2001, 2002, 2003, when everything was, bursting, let's just call it that. And you could look at so many of those different tech stocks in 01, 02, 03, and man, you got some incredible buying opportunities, and the exact same things happening in this market where you're getting some extraordinary buying opportunities. So anyways, guys, much love as always. I appreciate you joining me, and to the first video ever on this channel of hopefully many more. Have a great day.